Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 26th of November. I'm Daniel Lam, your host for the podcast. Yesterday, we talked about a view that US equities would likely outperform European equities, with most of the comments surrounding the US. Today, let us look at the other side of the equation. Let us dig deeper into Europe. Now, in order to assess the risk of this trade, one should look at the positioning towards European equities. Right now, it is only slightly below average. So given the headwind that European growth is facing, investors have room to add to short Europe positions. The forward-looking earnings is lending a similar picture. It has been weakening, but given the downgrade in third quarter earnings across key EU industries, the consensus numbers still look to be somewhat optimistic, especially taking into account of the threat of tariff from Donald Trump. Right now, European equities have underperformed since the elections, but that does not mean tariff risk have been well priced in, because there's still room to decline compared to the magnitude of the fall in 2019 tariff escalations. Now, let us take a look at the other drivers, such as China demand. Now, China's fiscal policy announcements have so far been underwhelming, but the majority of the October flows into Chinese equities have remained, especially in onshore equities. Now, EU luxury stocks, which typically has a high beta to Chinese stocks, has been trading relatively poorly via V, a combination of skepticism on China stimulus as well as Trump concerns. Lastly, there is the conflict between Russia and Ukraine. Trump's policy of pro-settlement means that there is a short window in which tensions will be elevated as both sides seek the upper hand ahead of Trump's inauguration and involvement in the conflict. So this lends further headwind on sentiment against European equities in the short term. Hence, all in all, US equities is likely to outperform given its cleaner macro and policy tailwind. For European equities to possibly turn around, we need to see more extreme positioning against them, as well as positive surprise catalysts on the macro front, such as de-escalation on the conflict between Russia and Ukraine. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.